Inflation is it's hard to ignore these days, right? It's there at the grocery store. It's there when you're thinking about your savings.
Right.
And it's definitely top of mind, I think, when we think about our investments.
Absolutely.
So today we're going to do a deep dive on this huge topic of inflation, and we've got some really great material to work with here.
We do.
We got Benjamin Graham, classic chapter, The Investor and Inflation.
Yeah.
And we're going to layer on top of that some more modern perspective from Jason Zweig.
Mm-hmm.
So with this deep dive, what we're really trying to do is unpack the historical relationship between inflation and investing, how we should think about investing, and really look at that classic question of stocks versus bonds, especially when prices are rising. And ultimately what we want to do is try to extract some of those enduring principles that can help you navigate today's crazy economic landscape. Now, one of the things that I noticed right away when looking at these sources is this sort of this long-held belief that stocks are a natural hedge against inflation.
Right.
They'll just automatically outpace rising prices.
Sure.
But as we'll see, the data and real-world experience really paint a much more nuanced picture. Okay, so we're gonna try to bring some clarity to that, to exactly when and how inflation truly impacts different kinds of assets.
Oh, good.
So let's start by getting some historical context on inflation itself.
Right.
And this is according to Graham.
Okay, sure.
So what I found really interesting here is that
Graham reminds us that this isn't the first time we've dealt with rising prices.
Rising prices,
He points to some significant periods in the past, most notably between 1915 and 1920, when the cost of living nearly doubled.
Wow.
In just 5 years.
Yeah, that's pretty rough.
And he contrasts that with a more recent period, 1965 to 1970, which saw a still substantial but less dramatic 15% increase in the cost of living.
Yeah.
And I think it's easy to just think that inflation is just on this constant upward climb,
Yeah.
But Graham makes this really important point that there have been periods where prices have actually gone down.
Yeah.
It wasn't always just about things getting more expensive.
That could work other ways.
So, and then in terms of
thinking about what the future might hold, Graham, at the time that he was writing, considers a potential 3% annual inflation rate as a reasonable assumption for investors to plan around.
Yeah.
And it's kind of interesting to compare that to where we are now and how our expectations may have shifted.
Sure.
Okay, so let's now dive into the question that I think is really central to investors, and that is this whole switch. Stocks versus bonds when inflation becomes a significant factor.
Right.
So Graham lays out the common argument.
Okay.
You hear this a lot, I think, that bonds are the ones that really suffer during inflation because they provide a fixed dollar income and principal, which, of course, get eaten away by rising prices.
By those rising prices,
And the flip side of that is
that stocks are seen as the heroes in this scenario because of the potential for dividend increases and price appreciation, which can maybe keep pace with or even outrun inflation.
Yeah, it seems to make sense on the surface.
Right. It's a logical argument, but Graham immediately injects some healthy skepticism into that simple picture. So he says, it's absurd to claim that stocks are always a better investment than bonds, no matter the circumstances.
Right.
It really depends on the prevailing market conditions.
It all depends,
How high are stock prices? How low are dividend yields relative to what bonds are offering?
Right.
And he stresses that there's no one-size-fits-all answer here.
Yeah.
Neither bonds nor stocks are universally superior. It makes total sense.
Right. It's all about the
specific situation.
Specific situation.
Yeah.
Now, Graham does acknowledge that the historical record shows that the Dow Jones Industrial Average, that collection of 30 large American companies, had a pretty impressive run from 1915 to 1970, delivering about an 8% annual compounded return when you include dividends, which definitely outpaced bonds over that same period.
Right.
But here's where I think it gets really interesting. Graham poses this crucial question.
Yeah.
Is there a persuasive reason to believe that stocks will do much better in the future than they did in the past? And his answer is a flat no.
A flat no.
He's cautioning against assuming that past performance will continue.
Right.
Especially when it comes to, with inflation.
The impact of inflation.
Yeah.
And he digs into this idea that there isn't really this clear, direct link between inflation and how the stock market performs.
Right.
He points to the 1966 to 1970 period as a key example. Where the cost of living jumped by a significant amount.
Yeah.
Yet both corporate earnings and stock prices actually declined.
Interesting.
So this common belief that inflation just automatically lifts all stocks really didn't hold true in that real world scenario.
In reality.
You know, when you hear that stocks beat inflation, it's like it really needs a huge asterisk. You know? With that asterisk saying its earnings power, that drives long-term stock returns, not just rising price level.
Yeah.
So this raises a really important question. If inflation doesn't automatically lead to higher stock earnings, well then what does determine how profitable companies are during inflationary times? And Graham's analysis here I thought was really insightful. He found that the earnings rate on capital for American businesses didn't generally advance with inflation. Think about it as how much profit a company makes for every dollar it has invested.
Right.
Graham's saying that that didn't necessarily go up with inflation.
So it's not a one-to-one relationship.
Not at all.
Interesting.
Right. Yeah. And what he found was that the growth in earnings for those Dow Jones companies wasn't primarily because
inflation was magically increasing the value of their existing assets.
Right.
Instead, it was largely due to reinvested profits.
Interesting.
So the companies were growing the amount of capital they had invested. And that's what boosted earnings over time.
Right.
And Graham makes this nuance point that wholesale prices, you know, prices that businesses pay for goods are actually more relevant to their earnings than what we think of as consumer prices, you know, the prices that we pay at the store.
Right.
But even when he looked at wholesale prices, he didn't see a direct proportionate increase in corporate profitability.
Interesting.
Right.
So other things going on.
And he identifies a few factors that really acted as headwinds, preventing inflation from just translating directly into higher corporate profits. And things like rising wage rates that increased faster than productivity gains.
So companies had to pay more.
Meaning, companies had to pay more for labor without a corresponding increase in output, and also the need for significant amounts of new capital investment, which could also put a drag on the overall return on the money they had invested.
On that return.
And then to kind of connect this to the bigger picture, Graham highlights this potentially concerning trend of the significant increase in core debt relative to their profits.
Corporate debt,
He points out that between 1950 and 1969, the amount of debt companies held grew much faster than their pre-tax profits.
And the profits.
And with interest rates generally rising during that time, that increasing debt became a real challenge for many businesses.
For sure.
And something that that inflation could actually make worse.
Could make even worse. Yeah.
The ratio of net earnings to corporate debt deteriorated significantly, indicating a weakening financial position.
Yeah, not good.
Not good.
Yeah.
So if stocks weren't necessarily this automatic inflation hedge that people assume, at least according to Graham's analysis.
Okay.
Well, then...
What about some other options?
What about other options?
Yeah.
And he does touch on a few.
He does, yeah.
Doesn't he?
Yeah.
So he briefly discusses gold, which, of course, has historically been viewed as a safe place to put your money during times when the value of currencies is falling.
It's falling, yeah.
But Graham dismisses it as a reliable investment hedge against inflation, mainly because it doesn't produce any income and its price increases over the long term, at least up to the time that he was writing, hadn't been particularly impressive compared to other types of assets.
I see.
And what about tangible assets, the
things,
that people sometimes turn to when they're worried about inflation?
Yeah, for sure.
What's his take on that?
So Graham's, he's pretty skeptical about those as well.
Okay.
He mentions things like diamonds, art, rare collectibles, acknowledging that some of them have seen significant price increases.
Right.
But he points out the artificial nature of their value.
Yeah.
How easily trends can change. The lack of real investment security in many of these areas. He uses a really a vivid example of a very expensive silver dollar that was sold for an enormous sum, but then later sold for a much smaller sum.
Right.
So
it just...
to illustrate his point that...
It seems more like speculating than...
It's not real investing.
Investing.
Yeah.
Yeah. Okay, and finally, what about real estate?
Yeah, real estate.
Which is often touted as a classic way...
Right, as a hedge.
To hedge against inflation.
Yeah.
What's his take?
So he acknowledges that real estate has long been considered a solid long-term investment that can offer some protection against rising prices.
Okay.
But he also cautions about how difficult it can be to sell quickly if you need the money.
It's illiquid.
So, it's illiquid.
Right.
The potential for making costly mistakes when you buy or sell in terms of location and price, and the fact that it's hard for the average investor to really diversify their holdings. It's hard to buy lots of different...
The big chunk of real
capital.
Yeah, exactly.
So while it might offer some protection, it's not a simple or easily accessible solution for everyone.
Not for everyone.
Okay.
Okay.
That gives us a really strong, I think, historical base from Graham. Let's now bring in Jason Zweig's more modern perspective and see how these ideas hold up today. And what additional insights he provides.
Okay.
So he starts by discussing something he calls money illusion.
Money illusion.
Okay.
What's that all about?
So what's interesting here is this concept of money illusion.
Okay.
And he uses a really clever example with 3 different hypothetical people buying and selling houses under different scenarios of inflation and deflation.
Okay.
And the core idea is that we tend to focus on the nominal or stated returns, the actual dollar amounts, rather than the real returns, which adjust for inflation and tell us how much our purchasing power has actually changed.
So in his example, someone who sold their house for less than they paid might have actually come out ahead in terms of what they could buy with the money.
Right.
Because of deflation.
Deflation.
Yeah.
While someone else who sold for a big profit during high inflation might not have even broken even in terms of their real purchasing power.
Right.
So it's a powerful reminder that
it is,
those impressive looking dollar gains can be misleading.
Yeah, they can be really misleading.
If you don't take inflation into account.
If you don't think about that inflation. And Zweig emphasizes this very practical takeaway.
Right.
We should always make it a habit to subtract a reasonable estimate of inflation.
Okay.
He suggests around 3%.
Around 3%.
From any investment returns we're projecting.
Got it.
This helps keep our expectations realistic.
Yeah.
So someone predicting a 10% annual return on stocks might really only be expecting a 7% increase in their actual buying power.
After accounting for inflation. Yeah.
So you have to actively fight this
you
money illusion to really be...
To be an informed investor.
You always have to be thinking in terms of what your money will actually buy you in the future.
Exactly.
Now, Zweig also introduces this framework of thinking about our assets.
In 3 mental buckets.
All right.
When we're considering inflation, can you walk us through those?
Sure. So Zweig suggests that we categorize our assets into financial capital, human capital, and physical capital. So financial capital includes the liquid assets we typically think of as investments, things like cash, bonds, stocks, REITs, commodities, things that can be readily converted to cash. Then we have human capital. And human capital is essentially your earning power, the current value of your future income from your job, your skills, your education. And then you have physical capital, which is your tangible possessions, your home, cars, collectibles you might own.
Any of that sort of thing.
So how do these different categories of capital
that's a good question.
relate to protecting ourselves against inflation?
Well, Zweig points out that while we often concentrate on our financial capital, when we think about investments, our human and physical capital also play a really significant role in our overall financial well-being and how well we can kind of weather those periods of inflation. So, for example, investing in your education or developing new skills can boost your human capital. Potentially allow your earning power to grow faster than inflation. And physical assets, while they might hold their value, don't typically generate income. And then within our financial capital, different types of assets offer varying levels of protection against rising prices.
That makes a lot of sense.
It does.
It's a much broader way of looking at our financial lives than just focusing on our investment portfolios. Now, going back to financial assets, Zweig reinforces Graham's idea that a true asset that hedges against inflation should have a very specific characteristic.
It should. Yeah, this is a crucial point. Zweig echoes Graham's emphasis that a genuine inflation hedge should consistently deliver higher returns when inflation is rising. And conversely, consistently deliver lower returns when the rate of inflation falls. And he stresses this notion of an asset that performs perfectly in all inflation scenarios is really just wishful thinking.
Like an investment paradigm.
That
doesn't exist.
It just doesn't exist.
So let's, keeping that definition in mind.
Let's examine some specific asset classes through Zweig's perspective and see how they've actually performed as inflation hedges.
Sounds good.
Let's start with gold.
Gold.
Since Graham touched on that. So Zweig acknowledges gold's long-standing reputation as a store of value.
It holds its value.
Its ability to maintain purchasing power over very long periods of time. But he points out that its actual investment returns after accounting for inflation have been quite disappointing when compared to bonds and especially stocks.
Compared to other things?
Less than 0.8% per year.
Wow.
From 1900 to 2022.
Less than 1%.
He also highlights its very unpredictable short-term performance. noting that it often doesn't move in lockstep with inflation and even declined.
Oh, well. During periods of high inflation, like 2021 and 2022, only to then see a rise when inflation
when it cooled
in 2023.
Right. Yeah, so it's not doing...
It might hold its value.
What it's supposed to be doing.
Over the very long run.
Yeah.
But as a...
not a short
or medium term way to protect against inflation.